All right, Todd. So next up, let's talk about another company in the space, a company called RadNet. That's ticker symbol RDNT. In comparison to Teladoc, relatively small in scale, and also to telemedicine makes up a very small percentage of their actual business. Todd, what can you tell us about this company?
Well, it's interesting because I hadn't spent any time learning about this company up until prepping for this show. So I wasn't very familiar with this story. And so digging into it, it's quite interesting. Okay, so what they do is they operate freestanding diagnostic imaging centers in the United States. Now, historically, getting radiology done, imaging done, that occurred in a hospital environment, which of course is expensive. What they're doing is they're partnering up with health centers and hospitals to create freestanding units where they're majority owners, and maybe these health centers own a small minority interest in them, with the goal of being able to deliver the same service faster, better, at a lower cost. And so far, it seems to be working. I mean, they've got 341 different outpatient imaging centers that they're running right now. About 86 of those are held in joint ventures with health system partners, but they're looking to try and boost that to 50% over time. The company does a pretty good business. I mean, in the most recent quarter, $242 million in revenue. Over an $800 million run rate for the company in terms of sales. But Shannon, the sales really aren't growing very quickly.
No. And when you look at the company itself in the past, so it has quadrupled in size since 2006. And this has, of course, been through acquisitions, but also it's got some organic growth. But the company is guiding really for about 1% to 3% organic growth over the long term. So this is not going to be your high growth stock if you are looking for one. But just to your point, Todd, it's got some really interesting strategic components about it. You mentioned, of course, it's building out the network of freestanding alternatives, which I love. And especially, too, as you have more price conscious consumers. Think about the millennials who are looking at prices. And now more than ever, you have consumers who, before they go into a physician, are looking at, okay, what kind of diagnostic test do I need and how much will it cost? And can I compare cost from place to place? And I think this is a company that is at least starting to fill that gap and allowing for this freestanding, lower cost, ambulatory setting environment will actually help to mitigate some of that. I think with the slower growth overall, and I think too, it's a big behavioral shift. It's a huge ship to turn if you think about it, because we're used to when we need diagnostic imaging, when I need an MRI, when I need a CT scan, I'm typically going to go to the hospital to get that done. And so going to these freestanding clinics that aren't associated with the hospital, I think there's just some of that behavioral adjustment that's needed. And of course, as you know, in healthcare, any sort of behavioral change takes time. So I think the story is compelling with RadNet. I think it'll be just a much slower, compelling story to watch.
Yeah, and they don't have a lot of pricing pressure because so much of their business comes from the Medicare crowd. So they're kind of at the whims of whatever the Medicare reimbursement rate's going to be for that next year. And, as far as turning that freighter, again, that's why they want to boost a lot of these joint ventures with these hospital systems because, you mentioned integration earlier and how a lot of these different companies are trying to integrate across the whole spectrum. You've got hospital systems buying up private practices. Well, if they're buying up those private practices, who do you think that the doctors are going to end up referring imaging to? They're going to refer it to the hospital system. So, as a standalone operator, that could be a competitive disadvantage. Now, an advantage from RadNet's perspective could be that, hey, we're relatively big fish in this independent freestanding marketplace. There are a lot of small fragmented companies that could be struggling much more than we are. We can go in, acquire these at a relatively good price, and then figure out new ways to work with these different health services providers in that area to drive sales growth. But I mean, again, 6% growth. You've said guiding for 1% to 3%, 6% growth last quarter, year over year. Most of that's coming from acquisitions. If you look at procedure volume over on the aggregate, their procedure volumes were up 3.5%. But again, because of acquisitions, if you look at same center procedure volumes, it only rose less than 1%. So I think this is kind of one of those steady Eddie things. Demand will increase over time because, again, aging baby boomers are going to demand many more healthcare services, including imaging. But I wouldn't expect this to be able to deliver same sort of, say, breakneck growth that, say, a Teladoc might. Now, as far as telemedicine goes, they have two products or solutions that they offer that, I think you could fall within that telemedicine camp. The first is their eRAD product solution, where it creates web-based cloud solutions that helps hospital systems manage their medical imaging workflow and their communications with their patients. So basically taking that hardware and all that data out of the hospital, putting it up in the cloud so that people can more easily share and review images between different facilities or locations. And then they also have imaging on call. And imaging on call, it does, I guess, teleradiology is probably the best way to look at it. And what they do is that they do it work in a couple different ways. For example, let's say that you have a hospital system that usually does its own stuff in-house, but it's got some staffing concerns it needs to fill, or it gets a really heavy volume in a certain period of time, and they need to ramp up their ability to read through these images that they're taking. Then they can reach out and remotely have RadNet's radiologists analyze the imagery and provide feedback, and they can do it relatively quickly. I think the average turnaround time is about 17 minutes, which is pretty rapid. So again, that can help hospital systems and overall reduce costs by sort of outsourcing some of that image reading.
Absolutely. And that's why you see some of the private payers really becoming more aggressive in sending patients to these freestanding sites, particularly Anthem and United Health. One interesting thing that I think you probably won't see in the near term, but something interesting to watch here is that this company is actually investing heavily in artificial intelligence. And so for healthcare investors, you probably already know radiology is probably one of the areas where AI is being invested in the most heavily. I think I read one stat, it was like over 50% of funds being invested in AI in the healthcare space are just in radiology alone. And so the company, they plan to talk more about this, and you'll probably see some acquisitions happening into 2019 and beyond. But I think this will be a really interesting space. I mean, think about it, Todd. If I can go get a diagnostic tool like a MRI, CT scan, AI then analyzes that scan and then sends a detailed report over to my physician, that not only saves time, but it also saves money as well.
Absolutely. That is potentially pretty disruptive. And, we could be a little bit of ways away on that, but it's just one of these, I guess, advances that you may actually end up seeing, and that would make, if that were to happen, if they were to launch something like that, that would certainly make me want to take another look at this company from a growth perspective and see whether or not, it becomes more, I guess, intriguing to me. If you look at the what they're expecting for sales this year, they came into the year expecting sales of $950 to $975 million for the year. They're actually now, because of a weak first quarter, because of sicknesses and weather and all sorts of things in the first quarter, they now expect $945 to $970 million. That's up from $922 million the prior year. So again, not gangbusters growth, but really intriguing, maybe a company to keep your eye on.